The stock market is always buzzing, much like the floor of the New York Stock Exchange. It's a dynamic environment where share prices rise and fall, reflecting the ebb and flow of investor sentiment. Today is no different. We're seeing a mix of green and red on the screens, indicating a day of cautious trading. Some sectors, like technology, are showing strength, while others, like energy, are lagging behind. Think of it like a marketplace, but instead of fruits and vegetables, we're trading pieces of companies. When a company does well, its stock price generally goes up. Conversely, negative news or economic downturns can lead to a decline. It's a constant tug-of-war between buyers and sellers, each trying to get the best price. This constant fluctuation can be daunting for newcomers, but understanding the basic forces at play can make it less intimidating. Factors like interest rates, inflation, and geopolitical events all play a role in shaping market direction. Keeping an eye on these indicators can provide valuable context for interpreting daily market movements. Remember, investing in the stock market is a marathon, not a sprint. It's about long-term growth and weathering the inevitable ups and downs. So stay informed, stay patient, and never invest more than you can afford to lose. The Dow Jones Industrial Average, often referred to as the Dow, is like the elder statesman of market indices. It tracks the performance of 30 large, well-established American companies, often household names representing various sectors of the economy. These aren't just any companies, they are the blue chips, the stalwarts of American industry. Think Coca-Cola, Boeing, and Apple, to name a few. Their combined performance provides a snapshot of the overall health of the U.S. stock market. When the Dow rises, it generally signals optimism about the economy. Investors are confident, businesses are investing, and consumers are spending. Conversely, a decline in the Dow can reflect concerns about economic growth, corporate profits, or global uncertainties. Keep in mind that the Dow is just one piece of the puzzle. It doesn't tell the whole story of the market, as it represents only a small slice of the thousands of publicly traded companies. However, its historical significance and influence on investor sentiment make it a closely watched barometer of market health. If the Dow is a snapshot, the S&P 500 is a panoramic view. It encompasses 500 of the largest publicly traded U.S. companies, representing a broader spectrum of industries and sectors compared to the Dow's narrower focus. Think of it as a diversified portfolio in itself, offering a more comprehensive picture of the overall market. From technology giants like Microsoft and Amazon to healthcare behemoths like United Health Group and Johnson & Johnson, the S&P 500 casts a wider net. Because of its broader representation, many investors consider the S&P 500 a more accurate reflection of the U.S. stock market's overall performance. It's often used as a benchmark for the performance of mutual funds and exchange-traded funds, or ETFs, that aim to track the large-cap segment of the market. Just like the Dow, the S&P 500 is influenced by a myriad of factors, including economic data, corporate earnings reports, and geopolitical events. Its movements can provide valuable insights into investor sentiment and the direction of the broader market. Imagine trying to understand the vastness of the ocean just by looking at a single drop of water. That's the challenge of understanding the stock market by focusing on just one or two individual stocks. Market indices like the Dow and the S&P 500 provide a broader perspective. These indices are like barometers, measuring the overall pressure or sentiment of the market. They aggregate the performance of a basket of stocks, giving investors a sense of whether the market is trending upwards or downwards. Think of it like this. If you want to know how the average temperature in a city is changing, you wouldn't just look at the thermometer in your backyard. You'd need to consider temperatures from different locations across the city to get an accurate picture. Market indices serve a similar purpose. They provide a benchmark for measuring the performance of your own investments. If your portfolio is consistently underperforming the market index, it might be time to reassess your investment strategy. Section 5, Hims and Hers, a case study. Now, let's dive into a specific company that's been making waves in the market, Hims and Hers. This telehealth company, specializing in personal wellness products and services, has seen its stock price fluctuate significantly since its public debut. Imagine a company that's tapping into the growing trend of online healthcare and making it easier for people to address sensitive health concerns. That's Hims and Hers in a nutshell. They've disrupted the traditional model by offering virtual consultations and personalized treatments for everything from hair loss to skincare. However, like any company, Hims & Hers faces challenges. Competition in the telehealth space is heating up, and the company needs to demonstrate continued growth and profitability to appease investors. Their recent earnings report showed promise, but the stock price remains volatile. This case study highlights the importance of conducting thorough research before investing in any stock. Past performance is not necessarily indicative of future results, and even companies with innovative business models can experience volatility. Section 6 Factors Influencing Stock Prices. The stock market is like a giant puzzle with countless pieces influencing its movements. Understanding these factors is key to making informed investment decisions. Let's break down some of the key drivers. First and foremost, economic data plays a crucial role. When the economy is strong, businesses thrive, consumer spending increases, and stock prices tend to rise. Conversely, economic slowdowns or recessions can lead to market downturns. Interest rates set by central banks also have a significant impact. Lower interest rates make it cheaper for businesses to borrow money, stimulating growth and potentially boosting stock prices. Higher rates, on the other hand, can slow down economic activity and weigh on the market. Geopolitical events such as trade wars, political instability, or global pandemics can inject uncertainty into the market, leading to increased volatility. Investors tend to seek safe haven assets during times of turmoil, which can impact stock prices. Section 7. Expert Opinions and Predictions. While predicting the stock market with certainty is impossible, even for seasoned professionals, gathering insights from experts can provide valuable perspective. Let's hear what some market analysts are saying about current trends and future projections. The market is currently in a state of flux, says renowned economist Dr. Emily Carter. Inflation remains a concern, but recent economic data suggests that we may be past the peak. The Federal Reserve's interest rate hikes seem to be having the desired effect, but we're not out of the woods yet. Meanwhile, veteran market strategist John Davis offers a more cautious outlook. Geopolitical risks, particularly the ongoing conflict in Europe, continue to cast a shadow over the market, he notes. Investors should brace for continued volatility in the near term. These are just a few examples of the diverse range of opinions you'll find among market experts. It's important to remember that no one has a crystal ball, and market predictions should be taken with a grain of salt. However, staying informed about different perspectives can help you make more informed investment decisions. Section 8. Investing Wisely. Tips for beginners. Navigating the stock market can seem daunting, especially for beginners. But remember, every seasoned investor was once a novice. Here are a few tips to get you started on the right foot. First and foremost, educate yourself. There are countless resources available, from books and articles to online courses and seminars, that can teach you the fundamentals of investing. Understanding basic concepts like market indices, stock valuations, and risk management is crucial. Secondly, start small and diversify. Don't put all your eggs in one basket. Instead, spread your investments across different companies, industries, and asset classes. Diversification helps mitigate risk and protect your portfolio from the volatile swings of individual stocks. Consider investing in low-cost index funds or exchange-traded funds, also known as ETFs, that track the performance of broad market indices like the S&P 500. This approach provides instant diversification and can be a good starting point for new investors. Section 9. The Future of the Stock Market. The stock market is a living, breathing entity, constantly evolving and adapting to new information and global events. While predicting its future with certainty is impossible, several trends suggest what we might expect in the years to come. Technology will undoubtedly continue to play a transformative role. The rise of artificial intelligence, machine learning, and big data is revolutionizing how companies operate and how investors analyze information. Sustainability is another major trend shaping the investment landscape. Investors are increasingly conscious of environmental, social, and governance factors, often referred to as ESG, when making investment decisions. Companies with strong ESG profiles are likely to attract more capital in the years to come. The global economy is becoming increasingly interconnected. Events in one part of the world can have ripple effects across financial markets, making it more critical than ever for investors to stay informed about global developments. The stock market will always be subject to cycles of boom and bust. However, by staying informed, investing wisely, and remaining patient, investors can navigate these fluctuations and potentially achieve their financial goals over the long term.